Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Gevo's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Gevo's mission is to transform renewable energy and carbon into energy-dense liquid hydrocarbons. These hydrocarbons can be used for transportation fuels such as gasoline, jet fuel, and diesel fuel. When they're burned, they have the potential to yield net zero greenhouse gas emissions when measured across their full life cycles. The company is headquartered in Englewood, Colorado, and was founded in 2005. It started trading in 2011 and can be found on the Nasdaq, Mexican Bolsa, Deutsche Börse, and London Stock Exchange. Its business model is built around removing greenhouse gas emissions and instead incorporating the use of renewable energy, including the sun's energy, through photosynthesis, wind power, and the use of biogas and renewable natural gas. Gevo uses low-carbon, renewable, resource-based carbohydrates as raw materials, and also they're in an advanced state of developing renewable electricity and renewable natural gas for use in production processes, resulting in low-carbon fuels with substantially reduced carbon intensity. Gevo's products perform as well or better than traditional fossil-based fuels in infrastructure and engines, but with substantially reduced greenhouse gas emissions. In addition to addressing the problems of fuels, Gevo's technology also enables certain plastics, such as polyester, to be made with more sustainable ingredients. Gevo's ability to penetrate the growing low-carbon fuels market depends on the price of oil and the value of abating carbon emissions that would otherwise increase greenhouse gas emissions. Gevo believes that its proven patented technology enabling the use of a variety of low-carbon sustainable feedstocks to produce price-sensitive low-carbon products such as gasoline components, jet fuel, and diesel fuel yields the potential to generate project and corporate returns that justify the build-out of a multi-billion-dollar business. Net Zero 1 is on target for completion by the end of this year. The company announced that Tony Wells has joined as its general manager for its future Net Zero 1 facility, expected to be located in Lake Preston, South Dakota. He brings 30-plus years of operations management, engineering, and business development experience. He is expected to lead and assemble the organization that will operate the Net Zero 1 facility. Net Zero 1 is expected to transform renewable energy into energy-dense liquids. The name Net Zero 1 is a reference to the net zero greenhouse gas emissions expected over the life of the fuel products, including the burning of the fuel in an engine or boiler. It currently has $1.6 billion worth of signed contracts, which is a positive indicator if you're invested in them. The company had total revenue of $63 million in 2018, 19, and 20 combined. $1.6 billion is like getting $63 million of revenue 25 times over. The total addressable market is 888 billion gallons of liquid fuels per year. So there is a lot of opportunity for many large companies to be part of this industry. This company's Net Zero 1 plant has 45 million gallons of capacity per year. Gevo will improve agriculture and put nutrition in the food chain. It will produce more protein products than fuel products. This will help farmers grow and employ more people. Every acre produces fuel and food. When the corn from the cornfield gets to the plant, it is separated and the starch goes into the fermentation process to produce biofuel, while the protein becomes animal feed that is fed back to the cows and used then to produce gas. Let's get started with the model. This is a small cap company, 1.2 billion market cap. They're trading at $6 a share and they have 198 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow every year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative every year. Revenue is the sales for the company, and that drops a lot from 33 million down to 1 million. The company had $100,000 of revenue in the first quarter of this year. That's compared to 3.8 million in the same time period last year. The company said hydrocarbon revenue was nothing compared to $100,000 last year. They're saying hydrocarbon sales decreased because of lower production volumes at Gevo's demonstration plant in Texas. They also had zero revenue in ethanol sales at its Minnesota plant. They did have $3.7 million last year. The company's saying this is in response to COVID-19 and high commodity prices. So the company terminated its production of ethanol and distiller grains in March 2020. They are performing maintenance in preparation for isobutanol production expected in June of this year. This is the company's income statement, so it doesn't look so great because their revenue has gone down so much. It looks like they're pivoting a lot and trying to change things up. Once their facilities are fully grown and commodity prices come down, they should start generating a lot more revenue. They do have a lot of contracts in place, so it does appear this year their revenue should be higher than ever. Their cost of revenue was higher than their revenue, so they have negative gross profit each year. They also have operating expenses, so they're even more negative for operating income. They did have $1.6 million of interest on their debt, which was lower than 2018, 19, or 20. And the bottom line of the income statement is their net income, which of course is negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So since they're not bringing in much revenue, they have negative operating cash flow every year. Capital expenditures are investments in property, plant, and equipment. They had $10 million of capex in the trailing 12 months. Operating cash flow minus capex give you your free cash flow, which of course is negative every year. Since they have negative free cash flow, they're mainly issuing capital stock to fund their operations. They issued $39 million in 2018, then $12 million, $76 million, and $560 million. They did 2 capital raises in January of this year. They issued 44 million shares at $8 a share, which gave them $322 million of proceeds. If you own the stock, you don't want to see them issuing more stock because your shares get diluted. But unfortunately, it's not your decision. The company can issue stock if they want. So you have to trust the company that they're issuing the stock to grow the business in the long term, which will make your shares higher. If you think they're issuing stock to pad their bonuses, then maybe you shouldn't buy the stock at all. So when a company issues stock, it's kind of a neutral event for me. When I say neutral, I just mean the idea of issuing stock. The only way you can analyze it is see how much money they issued per share. In the top example, they got paid $8 per share. A few months ago, the stock price was $1 a share. So if they wanted to raise $322 million a few months ago when the stock price was $1 a share, they would have had to sell 322 million shares. So it's much better that they're selling stock at $8 per share than $1 per share. There's less dilution. So if a company you're investing in is issuing stock when the stock price is really high, that's a good thing. But if they're issuing stock when the stock price is really low, that's a bad thing. But in January 2021, they issued 24 million shares and they received 136 million of proceeds. They did an at-the-market offering, which means they sold the shares at the market price. It's like if you want to buy stock, but you buy it whatever the market price is. So whatever it's trading at, you buy it. But they only received $5.50 per share. This situation was a lot worse than when they got $8 per share. The time they got $8 per share, it wasn't at the market. It's similar when you buy a stock and use a limit order. If the stock is trading at $7 a share, but you don't want to pay more than $6 per share, you set a limit order at $6. So once the stock price comes down to $6, you'll buy it. It's the opposite when you sell. You want to sell for higher. So most companies pick the price, similar to a limit order, and that's what they sell the shares at. But if the company really needs cash and they don't want to wait, they can do an at-the-market offering and not pick the price. Just take whatever price the shares are trading at. This is the equity section of their balance sheet, and they have $600 million of equity. They raised $1.1 billion from selling capital stock, and they have negative $500 million of retained earnings. Retained earnings is a sum of all your prior net incomes. So they lost $500 million since they started running the business. If they didn't do the capital raise in January, this would be about $600 million. So prior to the capital raise, the balance sheet indicated that they pretty much lost all the money they raised, which is obviously a bad thing. So now that they've raised another $500 million, they now have more equity on their balance sheet. So hopefully the company doesn't lose this $500 million like they did the prior $500 million. Let's look at their capital structure. They have $600 million of equity, $1 million of debt, so they're 100% equity. And their net debt is a big negative since they have a lot of cash on their balance sheet from the capital raises. Their weighted average cost of capital is 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7, that's $7.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.6 billion. We divide that by 198 million shares. And we get a calculated stock price of $23. They're trading at $6, so they're trading at a 74% discount. It's a buy according to the model. The way I projected their future free cash flows, I looked at analyst estimates. I looked at the contracts the company had in place. I thought it was conceivable they would have $500 million of free cash flow by 2027. Of course, this is just an estimate. Anything can happen. Simply, Wall Street is higher than me. They're at $48 a share. They're saying the stock is 87% undervalued. 2 analysts priced this stock and their average price target was $17. This is where the stock has been trading since it IPO'd, so it's really hard to tell in this chart because they did so many reverse stock splits, it really inflates their earlier stock prices. Their stock price was never over $100,000. It's just all these reverse stock splits make it look that way. This is where the stock has been trading the last 12 months. It was under $1 for a while, and when the company announced its South Dakota project, the stock jumped 15%. Even though this wasn't a new announcement, the market didn't really know about it until January. This stock got a really big boost when their co-founder was added to the president's Council of Advisors on Science and Technology. Even though their co-founder is no longer with the company still got credit for this. That's pretty much why Gevo issued all the new stock, because the stock price was driven up and they wanted to take advantage of that. This is a really volatile stock. It has a beta of 3.32, so the stock moves more than 3 times the market. It's gone up 941% in the past 52 weeks, much better than S&P 500. In the past 52 weeks, the stock was as low as 51 cents and as high as 15.57, and the stock is currently trading lower than its 50-day and 200-day moving average. This is a really liquid stock. 11 million shares are traded on average the past 3 months. Of the 198 million shares outstanding, 189 million are on float, 26% are held by institutions, and it has a pretty high short percentage. Over 13% of the shares are shorted. And the stock has done really well the past year and past 3 years, but it's down a lot in the past 5 years due to all the reverse stock splits. Analysts are bullish on this stock, expecting their earnings to grow 66%, their revenue to grow 72%. In the past 5 years, their annual earnings are flat, but in the past year, their earnings are down 29%. If you invested $10,000 into this company 10 years ago, your shares would have been diluted down to pretty much nothing, under $1. State Street owns 11 million shares, then Vanguard, Invesco, Renaissance Technologies, and BlackRock. Let's look at their financial ratios. We can't look at the PE because they have negative net income. They have really low sales, so they have a terrible price to sales ratio. And they do have a good price to book ratio because they have so much cash on their balance sheet from all the capital raises. They have a really high current ratio, a high quick ratio, mainly because they have over $500 million of cash on their balance sheet. So the company is well capitalized. They have enough cash to last them a few years. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on Chemtrade, W.R. Grace, Linde, and LyondellBasell, all in the same industry as Gevo. And if Gevo has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in PE and price to sales. They are better than average in price to book and current ratio, but that's mainly because of those capital raises. So when a company has a really good current ratio or price to book because they raised cash, I don't consider that a positive. It's a neutral to me. If they have a lot of cash on their balance sheet because they sold a lot of products and made a profit, that's a positive. When they raise capital, it's just a neutral to me. So even though their price to book is better than average, I don't consider it a good ratio because of that. And they have no debt, which is good, and they're a pretty small company, 1.2 billion market cap. So to summarize, I have them trading at a 74% discount. There's really 2 ways they can succeed. The Biden administration needs to continue supporting what this company does, not just supporting them by saying we need a greener environment, but financially supporting these types of companies. And the other thing they need to do is execute on their plans, because they've seemed to pivot a lot over the years, and they really haven't been too successful. I know it takes time to grow these types of things, but so far they've just diluted their shareholders and haven't shown much for it. But it is obvious they have lots of plans in place, plus they have contracts, and their facilities are up and running. So there are a lot of positives, even though there are some negatives. I rank their free cash flows, revenue, and ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.